BDC sector is the media's new commercial real estate. Every possible chance they get to talk about it and put out a big bad headline, they're going to do it.
Welcome to Fixed and Floating, the credit podcast. My name is Josef Pschorn, and in each episode, we explore the forces shaping credit markets. The recent news flow has put BDCs firmly into the spotlight. Investors in Blue Oil's BDCs have submitted redemption requests of roughly 18%, well above the quarterly limit of 5%. While recent write-downs at BlackRock's BDCs have raised fresh questions about credit quality. To help separate facts from rumors and to think about BDCs properly, Giordano from Seaport has put together a very comprehensive slide deck that walks through how credit investors should think about that part of the private debt market. John, welcome to the show.
Hi, Joseph. Thanks for having me. For those of you who don't know me, I'm the co-head of credit research at Seaport Global. Obviously, anything I speak about today will be my own opinions and not necessarily the opinions of Seaport. I am responsible for both investment grade and high yield financials. I also cover the hybrid and preferred market, and BDCs fall within the financials. So obviously, we've been very active in the sector. And we did this very large presentation in mid-January. We have sort of a consolidated version here for you, but I think we can give you a pretty good idea of things that we're hearing from clients. And so thanks, Joseph.
To set the scene, what exactly are BDCs and where do they fit into the broader private debt ecosystem?
Sure, Joseph. So business development companies have been around for quite some time, certainly before the financial crisis. Born out of the Small Business Act. And it really was a way for retail investors to be able to access private credit. We say it's much like the REIT sector, where the REITs were created for retail investors to access commercial real estate. They have similar structures in terms of tax pass-throughs and similar requirements in terms of 70% of the assets need to be access to small business. 90% of the taxable income needs to be paid out as dividends, which attracts income-oriented investors, and then limitations on leverage of 2 to 1, which was raised from 1.5 times to 1 a number of years ago, and minimum asset coverage ratios to sort of help protect that. So, if you look at the BDC sector, I'm going to basically talk about BDCs that are issuing unsecured debt, because that's what I trade on the corporate bond desk. But what we've seen is as private credit has grown for a number of reasons. Post the financial crisis, there were a number of restrictions put on the big banks through Basel III in the terms of assets and the RBC charges that were labeled against them. So these types of loans that we'll talk about in a minute are a little bit punitive for the banks, or just not the type of loans that they want to give that sort of flexibility to the smaller growth-oriented companies. So we basically, if we move to slide 2, you'll see 3 types of BDCs that we focus on. So there's the publicly traded BDCs. These are the ones where you can access, you can buy mail through your brokerage account. You'll see them listed on the exchanges. There's roughly 91 billion of total debt. We also break things down by whether it's index eligible. This would be large corporate bond index that we follow here in the U.S. There's about 40 billion of index eligible debt there. These typically pay out quarterly. It's open to all investors. They're very, very liquid because the equities are traded on the exchange. The debt is traded OTC with folks like ourselves and the other big banks. The largest and fastest growing segment in the BDC is these perpetual life loans. So there's roughly 46 BDCs with 277 billion of assets. Currently, it might be actually a little bit bigger at this point, representing about 114 billion of debt, of which about 20 billion of that is index eligible. These are a little bit different in unlike the publicly traded companies, which offer their equity through an IPO and potentially subsequent ATM offerings. The perpetual life BDCs are doing a continual offering at NAV. And they pay monthly as opposed to quarterly of the public one. Again, this is really being driven by the high net worth and brokerage community who want high income and want it on a monthly basis. So it's really structured that way. So if you have a financial advisor or an RIA, you're probably going to be offered one of these perpetual-like BDCs if you're asking about accessing private credit. And then there's the third bucket, which is a little bit smaller, is the private placements, which are really offered to accredited investors. And so you will find that the BDC manager may have all three of these buckets. And they'll have a portfolio of different types of BDCs to offer it to different types of institutional and retail investors. Why you've had this sort of growth in the perpetual segment, which is really the one I say is growing the most. So this access to private credit for retail and wealth channels, and there's a number of reasons too. Remember, we just came through a very high rate environment, even though the Fed is lowering rates right now. If you look at annuity flows and you look at the flows into any high income oriented assets, BDCs and private credit being one of those, it's really grown tremendously for those reasons. Again, the perpetual BDCs are structured to have a stable NAV. They give you some liquidity, quarterly liquidity. I think you mentioned that in the beginning, Joseph, in terms of some of the outflows. Those redemptions are typically capped at 5%. However, the BDCs do have the option, at their option, if they want to remove those gates. And then, as I said earlier, they tend to be monthly distributions as opposed to quarterly. That's again a more of a retail focus, but quite popular.
Sure, I think one important feature is the RIC status, right? You mentioned that.
If we went to slide 6 and you looked at the regulatory framework requirements under the Investment Act of 1940, it made it a much more easier asset class to get into retail. The REC status gave them the tax pass-through, which made it advantageous for the BDCs to hold these assets, right? And you kind of eliminate double taxation.
No, that makes totally sense. How important was the pullback of banks from lending to middle market companies?
Well, post the financial crisis, there were a bevy of non-bank financial institutions. You could speak to the growth in non-bank mortgage originators, which all came out of the financial crisis, and then the higher capital limits, stress testing, all these different things that the banks now undergo, basically allowed this type of lending to sort of move off banks' balance sheets and into the shadow banking system, which would put private credit in there.
But the growth was supercharged in the last couple of years.
I go back to again the growth on the perpetual BDCs, opening it up to, and there's been a huge push by the banks to push into the high net worth space, right? So it's all kind of circular, and you have a very high rate. You had a very high rate environment, a very steep curve. Again, that's why the annuity flows have also been extremely strong, right? They're all sort of correlated. There's a huge push to serve that client base.
So you would say the high rate environment, while it was detrimental for the cash flows at the actual companies, it was very beneficial for the actual asset class.
Certainly, in part, yeah, it certainly created a lot of demand to parse that out. Sure.
That makes sense. Let's walk through how a BDC is structured. How does a typical portfolio look like at the portfolio level?
I believe in the beginning, they're catering to very small and middle market companies with annual revenues between $10 million to $1 billion, EBITDA of $10 million to $300 million, and 4.5 to 6.5 times levered, call it. Loan terms can vary. They can be 12 to 24 months, but on average, it's 4 to 6 years, and they tend to be non-investment grade companies. Currently, as the market has become more competitive, to your point, Joseph, with the growth, the current average is closer to 100 to 250 million in annual revenues, with roughly 200 million in EBITDA. Leverage is crept up a bit, 5.6 times, but still below it's kind of in the middle of the ranges we've seen before. I think importantly, most of the portfolios tend to be first lien. Right now, the average is about 89%, so pretty high. But they will have second lien, mezz, and can have equity as well. But overall, on average, we're 89% first lien. So they tend to be in a pretty high spot in the cap structure, and typically floating rate.
I think an important point you just raised is that most of the companies which are targeted by BDCs are or have been kind of neglected by banks, right?
I wouldn't say it's neglected. I would say, they can be high growth. I don't want to say startup, but in that, and it could be a B or C round of financing, a lot of fintech sort of stuff, right? Tech and healthcare tends to be, there's a lot of PE sponsored companies, and the reason why there's a lot of PE sponsored companies, generally puts in a lot of equity, and so that's a great thing to lend against, and PE companies will typically support those companies as right. They're looking for an exit, right? Typically a sale or an IPO. So they not only do they have a lot of equity beneath the BDC lender or other private credit lender, they're willing to support that to get it to the end goal. To answer your point a little more directly as well, one of the things that has driven the growth in BDCs and this type of lending is because the BDCs can do the type of loans that banks typically don't like to do. Like PIK is the big bad word right now, right? Pay in kind. And so, a company that's growing and maybe constrained for cash flow, but sees the product cycle, starting to mature, they can structure a loan with a PIK component that helps that company get to where it needs to be. Where a bank is going to be, if you look at a bank syndicated loan or BSL loan, you're going to see a lot less PIK structures than you might see, and it doesn't mean it's bad. The flexibility that a BDC can provide small growth stage sort of companies and developing companies is much more flexibility than what the banks can do.
That makes sense. You have just mentioned that usually, or some parts of the loans at least, have relatively loan to value ratios, right? In general, BDCs also need to have a relatively high asset coverage within them, right? I think the number is around 150%. Similarly, they need to hold 70% in eligible assets and need to distribute 90% of their income.
Correct. Yes, we mentioned
Are there ways to kind of bend the rules a bit? I mean, especially with the 150% asset coverage.
Well, I wouldn't. I don't know if I'd bend the rules, but I'd say, as any good credit analyst, we take our own view on how we look at leverage and coverage. The numbers that you just mentioned, the 2-to-1 debt to equity and the 1.5 times asset coverage ratio, are regulatory measures. So they don't factor in. Let's say you have a company that issues a lot of preps, right? Preferreds. A lot of people look at preferred equity as debt. Yeah. Right? It's a continuous payment that you have to pay. Or you have some sort of other structural debt on your balance sheet that doesn't get captured under the regulatory ratio, your leverage could look a bit higher. So, but now, as much as you could say, aha, look what they're doing, you also have to remember the access to capital is really important for them. They can't retain capital. They're paying out 90% of their taxable income. So one of the reasons why we've had a huge growth in the unsecured market is, and again, this follows the REIT sector very closely, which is more unsecured debt I can issue, the more unencumbered my assets become, and the rating agencies love unencumbered assets, and my ratings go up. Right, 2024 and even in 2025, we're finally seeing some separation, as every BDC used to be low triple B. Now they're creeping up into mid triple B because they have a little bit longer track records, the growth of assets, and they're unencumbering the balance sheets. So the rating agencies are going to pay attention. They're going to use their own metrics and say, yeah, these guys are levered a lot more. I try to stay away from names too much here, but Prospect Capital is probably a good example where this company was under earning its dividend, issuing a ton of preferreds to sort of fund the dividend, really levering the company up, and was one of the first ones in recent memory that went from investment grade to high yield. That's costing them. It's costing them a big number on their cost of capital. So, you can get around it from the regulatory side to a degree. Even at 2-to-1 and 1.5 times asset coverage, assets can fall a lot, and bondholders are still very covered.
No, that makes totally sense. I think you have put together a very good example where you go through the P&L of a BDC, explain the income characteristics, and also what they pay out in terms of funding. So I think it's a very, very good example to understand the cash flow mechanics behind a BDC. Would you mind walking us through that example, please?
Sure. Slide 7 is really just a hypothetical example of, okay, you had 10 billion in assets, SOFR's at around 365. The average first lien lending spread is around 5%. That gives you income of around 865. Part of the way BDCs will make money is many of them are third-party managed, so there's an asset manager overseeing a portfolio of different funds, and there is a management fee associated with that. So you'll see this, base management fee of roughly 1.25% of assets. You'll also see some incentive fees that are baked in there, and then you're going to take out so you have your total fees, you have an interest cost, and you get to a net investment income (NII), which is really sort of the cash flow of BDCs. There can also be realized gains and losses that can move that number a little bit, and ultimately will get you down to. And there's also some fee on the gains. Got to have your fees. It gets you down to a dividend yield, in which case we're paying out 90% of that net income. When you look at the different types of funding sources, you're going to see secured debt. There may be wholesale lines. There may be revolvers, things like that. Then you have sort of my part of the world, which is unsecured, which is roughly 42% of funding across the BDCs that we cover right now. And then you'll see a fair amount of CLOs. It's roughly 15%. And we've given you sort of the varying costs there, based on some averages that we've come up with, anywhere from 5.5% to 6.5%. Depends on the REIT too. Smaller REITs are paying more than that on average, and this is going to be a little skewed towards the bigger REITs.
How would you say that a BDC's credit profile differs from a bank or an insurer making the same loan?
Well, again, it comes back to very different regulatory requirements where a BDC is beholden to leverage and coverage. They don't have an RBC sort of thought process, right? Risk-based capital, where the riskier the asset is, the more capital you have to hold against it. Banks are largely deposit funded, which is, considered stickier, though deposits can be flighty at times. They're stress tested if it's a large GSIB. The regulators are constantly going even to the smaller banks and doing examinations and coming up with grades. That's called CAMEL. A BDC is a lot more opaque, right? Well, we do get all the loan disclosure. A lot of them are small private loans. They're basically wholesale funded, right? So we've just given you an example of secured warehouse lines or CLOs or unsecured debt, and equity, of course. So paying out 90% of your taxable income, it's very hard to retain and build capital.
Can you actually track down the same loan across BDC, CLOs, and private funds, and do marks differ between them?
You can. It's a bit of work. There are some third-party services as well that are doing a really good job at that. So typically, what we'll do is, I guess, an example would be the write-down that you mentioned. TCPC is a perfect example. Those were looked to be a couple different Amazon aggregator loans that took a big hit. They were able to go through in some of our databases. You could do it manually, but there are databases that aggregate that stuff for us. And what we find is that you saw the biggest exposure take the biggest hit, and most of the other exposures to the same loan are quite smaller. But yes, you can do that, but it's easier through a third party. part of the trick of the BDCs. There's a lot of small little loans, right? So it's death by a thousand cuts. So you have to have a lot of things really go wrong. But yes, when there is a problem loan, you have to spend some time trying to track down what other BDCs or to your point, other structures might have exposures to that.
You just mentioned the granularity of the portfolio. How granular can these portfolios be?
Well, I think like I said, I think the disclosure is quite good. I think you can have 50 or 60 loans in a portfolio. The top 10 exposures generally aren't too big. You will get a lumpy, some lumpy stuff here or there. The trick is really understanding, and I think where some of the caution comes in on the sector. Where today, actually, where we're filming this, BDCs are widening out a bunch based on sort of what's going on in the software sector and revaluation there. People start to question marks, right? Because there are a number of these loans that are, like I said, they're private and they're third-party marked, and should they be par? We do find examples where maybe a loan got restructured or something, and then you look and it's marked higher than you would expect on a balance sheet. But I wouldn't say that that's the norm, but it does happen from time to time.
I think you mentioned it. I think BDCs also have an interest in being good in marking the loan, given that they also are comped with other BDCs, right?
Yes, I think that's correct.
BDCs are usually heavily concentrated in growth sectors like technology with 20%, healthcare 17%, services with 17%. What does the concentration in these sectors tell us about the credit quality of BDCs?
Well, again, it comes back to what I mentioned earlier, that there are financing growth-oriented, services-oriented companies, right? So tech and healthcare tend to be in areas that have long-term contracts, with vertically integrated systems and maybe dealing with proprietary information, right? So those are the sort of things that they like to lend against, right? And it's also this long-term contracts, lots of cash flow. Those are the things that PE folks like to buy. It's all kind of circular, right? So there could be fintech in there, and other like you said, high multiple businesses that but are asset light and generate a lot of cash, right? As they move along. So as I said earlier, they tend to be non-investment grade companies or not rated. I think we have that in our earlier slide.
You have mentioned the bad P word, PIK. This is also, I think, highest for these exact sectors. So tech with 23%, healthcare 19%, and also services 15%. Why is PIK so high for these sectors?
Yeah, again, there's different types of PIK. So PIK at origination, again, you are giving the flexibility of a company to retain cash to grow its company and its business, right? As it looks for whether it's going to IPO or exit or it's going to get bought or something. Doesn't mean that they're picking, and it doesn't mean they're picking 100% either, right? They might be picking 10 or 15%, depending on the type of company and the product and everything else. The structure at origination can vary. Now, it's growth in PIK by amendment where the company's running into trouble and can't pay its bills. And there you have two choices, right? The non-accrual, it goes on non-accrual, which I know you're going to ask about, or they amend it and give it some time to right itself, or it's going to go on non-accrual and get written off, or they're going to take the whole company, right, and take the equity. So there are really two different types. But I think in general, what you're seeing is that they're lending to areas that are growth oriented and or need to conserve cash. So they're giving them that option. Now we have seen a little bit of a spike in PIK over the last couple of years or last year and a half. Part of that's maturation too, right? of the sector. So one of the things I would note is you'll see much lower PIK and non-accruals in the perpetual BDCs versus the public, and that's because they're newer and they just haven't seasoned as much. Right? So we get that question a lot. So.
You've just mentioned the concept of non-accruals. Can you first give listeners an understanding of what you can understand about non-accruals?
There's certainly a relationship between non-accruals and PIK. So, if non-accruals are all of a sudden coming down and PIK is going up, we know that their PIK by amendment might be growing, right? And then we will question. If non-accruals are growing, then we know that is probably going to be a write-off and a write-down and a hit to equity. So there's a couple of things to think. There's, as I said, the better PIK is certainly strategically done at origination, giving that company that flexibility. But when we start seeing a fair amount of PIK by amendment, you could call it a shadow default. You call it whatever you like. That essentially gets a little concerning. Now, what's important, and the other side of that, as PIK grows, the company still, the BDC still has to pay out 90% of its taxable income. That PIK income counts. And so that is why we haven't really talked about on the public side, the price to NAV is at a pretty decent discount right now. And part of that is the expectation as PIK income has grown, you're seeing dividend coverages come down, and rates are coming down as well, which is base rates within the portfolios are coming down, and interest and PIK and dividend coverage is coming down. You have to cut dividends, right? So I think one of the things we didn't really discuss, which is some of the outflows that we've seen, I think have been more driven by a little bit by sort of the media hysteria. I would say, I look at BDC sector is media's new commercial real estate. Every possible chance they get to talk about it and put out a big bad headline, they're going to do it. But I do think if we looked at everything in a vacuum, rates are coming down, people will cycle the different types of assets and investments. So we know dividends are going to come down because interest rates are coming down, base rates are coming down, right? So their assets are floating, so they have to cut the dividend to right size that, and otherwise they're funding the dividend with debt, or they're selling assets to do that, and that's value destruction. So you can play with PIK a little bit, but at some point you gotta pay the piper, right? You can't just PIK into infinity, and then you may have to write that off.
Sure. So what you're basically saying, if you PIK above 10%, you're not able to cover your dividends. Is that how we can think about it?
Well, I think you should start. People are going to be doing the math to see if you're covering the dividends. Yeah. Certainly, when you start getting over 10%, people start raising their eyebrows, for sure. Doesn't mean that they can't fund it, but it is signaling something's going on, right? And generally that usually means there's a dividend cut coming, right? Which obviously you get these big hits to the public equities if they're there, or you get redemptions, right? Which is what we saw.
But I think it's still important to note that while you could have for some period a PIK ratio of over 10 or any given number, but it can easily come down, right? If the credit quality of the underlying business improves, PIK can go away, right?
Of course. Yeah. And you have rates coming down, which may allow some of these more stressed loans to refinance away.
Another key theme which is coming up is that public and private BDCs have higher PIK rates than perpetual BDCs. What's the key driver behind that?
Sure. There's probably two main drivers for that. One, the perpetual BDCs, their loan vintages are a bit younger. So many BDCs are only 3 to 5 years old, and so they really haven't experienced the full loan cycle. And then the perpetual BDCs tend to have a higher higher amount of BSL loans, so bank syndicated loans, basically for liquidity purposes. If they do have redemptions, they're not selling illiquid loans. They can use cash, they can use a bank line if they want, but they can also easily sell bank syndicated loans, so they just have less PIK oriented loans in the portfolio as well.
I think that's also a key element you just mentioned, that BDCs also have some liquid assets, right? It's not all illiquid direct lending.
Correct.
I think it's time to get our hands dirty. If you look at a BDC from the credit side, how do you evaluate the credit profile of a certain issuer?
Sure. So slide 11, if you were to move to that, we have a number of the public BDCs listed here. And this is really just a high level, but it's a great way to sort of capture across a number of BDCs sort of how we would think about it. Obviously, we've ranked them here from largest in assets and then scaled it down to some of the smaller ones. And we're obviously going to look at how big's the company. That matters. How much debt, how levered are they? How much equity do they have? First lien exposure is really important. Like I said, you're at a 79% average here. So who's above and who's below that? Those that are below it, what type of second lien or mezz or equity exposures do they have, and how do we feel about that? The public BDCs are a little, have a nice indicator, which is your price to NAV, right? You can see that every day. And how is the equity market valuing that company? Again, as I mentioned earlier, if you have a large discount to NAV, it might be because people are expecting dividend cuts based on the rate environment, and it may indicate asset quality issues as well, or a potential write down. But we tend to lean towards, right now, I think it's more rates, but there's certainly some negative comments going on about some assets that the companies have, the software, that kind of thing, which is probably driving down NAVs a little bit. As we just spoke about, percent of PIK is important, and on average we're about 8%. So someone who's at 15%, you can look on this chart and you can see who that is. Well, guess what? They trade the widest and probably on the shortest leash from the rating agencies. So rectifying that situation and stabilizing those situations is going to be very important to them. As I said, there's a sort of interplay between the PIK and then non-accruals. So certainly if you have very high PIK and you have growing non-accrual, then we have a really big problem, for sure. Leverage from a debt to equity standpoint, again, 1.2 is the average, even though they can go to 2. I'd argue that most of the BDCs run pretty conservative leverage, which gives them a lot of leeway for a lot of things, right? So, and then how is the book marked, and how much of it's marked below 80% again, and that's going to flow into the non-accruals again. And then, as we also mentioned earlier, dividend coverage, right? Who's covering their dividend and who's not. So if you have growing non-accruals, growing PIK, and a shrinking dividend, we take a hard look at that, and it's probably going to be reflected in the credit spread. And then what's not on this is all numerical stuff, is obviously how do you feel about the management team? How's the management team? What's their track record? Right? That is probably the biggest intangible. One of the things I would say is when you're looking at a BDC is, there's only so much they can differentiate themselves with, right? Leverage is limited. You have to be careful with your PIK and these other things. But it really comes down to the management team, their style, what types of companies they're financing, and how do they act in certain situations, and how do they handle some of these more difficult situations.
If you're comparing different issuers, what metrics actually correlate with performance? What are like the most important metrics to monitor?
Well, I mean, I think some of the things you've outlined here, I mean, PIK is just an easy one, right? If you have a high PIK and growing PIK, you are going to be in the spotlight, right? If you do have, if you're not covering your dividends and you're not cutting it, well, how are you financing that, right? And to the extent you're going out and borrowing on your line, not selling assets, well, then you're leveraging up, right? That is going to be important. I mean, it's all kind of circular. I wouldn't point to just one thing, but all these things interact, right?
But wouldn't like cutting the dividend be a negative sign to investors? And would that then also imply that your net asset base is decreasing and you would basically shrink your whole balance sheet?
Not necessarily. I mean, you have floating rate assets, and so again, SOFR's coming down. Your interest income on your loans is coming down. If you're not earning it other ways or putting new assets on, you're going to have to right size your dividend. It's part of that is part of the cycle. It's when it's not part of it's when it's the cycle of, to your point, credit losses, non-accruals, stress, and they're cutting the dividend. That's there's so it's an interplay, I would say, between both of those. So certainly right now people are worried that there's a little bit of both going on, right? Rates are coming down, base rates are coming down, and now you're seeing rising, non-accruals and PIKs in certain instances, or people feel like that might be coming for some of these smaller companies, and so they're pushing down some of the values, right? And then again, this is where management comes in. And how do they, how prepared are they? Again, low leverage leaves a lot of room for these guys to absorb losses if need be, or they want to borrow to keep that dividend stable for a period of time until they feel the market kind of, or they can reinvest at better spreads and correct that situation. So again, you can only fight that fight for so long.
We have seen a lot of issuance, especially in the unsecured sector over the last couple of years. That was also driven by a lot of inflows in the asset class. Are we set to see further increases in the size of unsecured debt for BDCs?
It does feel like it's been quite a flood. Again, I think BDCs have found the magic sauce with the rating agencies, which is, if I can issue enough unsecured debt and uncover my assets, I'm going to get better credit rating. If I get better credit ratings, you bring in more investors. The more debt that gets issued, the bigger part of the index it becomes, and then you have folks who kind of need to own it, otherwise you're short. So there's a little bit of self-fulfilling prophecy. I also think the more the issue, the further out the curve they can go. Well, you don't want to have large asset liability mismatches. Even the REIT sector is the same thing, right? It depends on the type of REIT, but you can have loans that have 7 to 10 years. You could have a triple net lease. It's got a very long, and so they have dabbled out past 10, 20, and they'll do some 30, but it's not their main focus is all 5, 10, 7s, all that kind of stuff, right? So I think BDCs will follow a very similar trend and are following a very similar trend. They've kind of proven themselves. We're having a little bit of some little turbulence right now, but this is part of the maturation of the sector, and over time, I think you're going to continue to see. I don't see any abatement to the issuance, to answer your question. In fact, I expect a couple deals before I finish this podcast. I think it all just kind of feeds on itself. Now, you're getting paid for that risk over the broader investment grade market. I think when we did the original presentation, it was like 98 basis points. We've had some, like I said, negative headlines with software and a little bit of revaluation in the sector, and it's probably plus 110 or so to the investment grade, and in the very short end of the curve. So there are a lot of people, and you have huge asset coverage.
Yeah.
So there are a lot of people who find that very attractive. In these times, we do find in these times of stress, spreads will blow out a bit, and then people will come in and try and bite it wider, and you can't find an offering. So it can get very frustrating from an investor standpoint. So that illiquidity in some of these smaller names can move the spreads around. It doesn't necessarily mean paper trading there.
That makes sense. I think you have brought also an example of an actual issuer, HLEND, so HPS, where we dig into the funding structure of the BDC. Would you mind explaining to listeners how the funding structure actually works for HLEND?
Sure. Yeah, and again, we just picked this so that was a real life example. We weren't making up. It's no opinion either way on the name. But here is, I think what you're going to see on this is just how diverse the funding structures are, right? So you can see, as I mentioned earlier, you obviously you have common equity, which start there, not necessarily your funding structure, but you can fund yourself somewhat with that. But you have a number of different funding facilities that are all secured, that are basically used to fund your loans. You may put those into CLOs, right? So you have secured borrowings that are, many of them are CLO managers as well. And then you will have, the unsecured market. You can have private placements as well. So, I would say overall, when you look at this, you can see that, it is, and after all of that, you are, have a very, very nice, unsecured 3.4 times asset coverage, right? So, this is a bigger BDC, but you can see as these things mature, and they diversify out their funding, but even being I would call it almost being at the bottom here, right? These unsecureds still have very, very good asset.
It also seems that it's very attractive for banks to lend against BDCs, right? Because as you said, a lot of asset coverage and also relatively attractive spreads, which is probably attractive for them from a capital point of view.
Sure, they may be getting some of that funding from PE as well. Some of their sponsors, right? And they're very correlated.
So what you're saying is that they also get some of their funding from the sponsors as well?
It can happen, yes. Mm-hmm.
Another very interesting point you mentioned before is management selection. It seems to be one of the key differentiators. I think we can differentiate between internal and externally managed. Would you mind explaining the key differences to listeners?
Sure. I mean, internal is a lot less common, but internal is, your underwriting, management, everything is all, within the BDC. What you tend to find is externally managed. Take the biggest, public ones that we've seen, and they're going to have an asset management division that is basically overseeing, could be a public, could be a perpetual and private portfolio of BDCs, right? And they will allocate across those and manage all those for a fee, right? So fees tend to be a little bit higher in the externally managed ones. They're obviously incentivized to grow assets and grow fees. Where the internal ones are more likely, not necessarily, but more likely to be, incentivized in a more standard way with, return on equity, whatever it may be. So, but again, the internally ones tend to be a little rarer than the externally ones.
I think some of the BDCs are very concentrated. So the top 10 BDCs control currently 51% of the assets. And I think 4 managers manage 160 billion across multiple strategies. Why do they run separate strategies or separate vehicles? And how, you just briefly mentioned it, but how do incentives shape the underwriting?
Well, I don't think incentives change the underwriting. I think you will find what they have different. Again, like if you looked, we have a slide here that shows the top 10 BDCs hold 51% of all the assets. They tend to be, both public and perpetual BDCs, right, from same managers, or in a lot of cases, right. So that asset manager is looking at different channels. So as I said, the public channel is a little bit more liquid. You have the perpetual channel, which is really going into high net worth, and then you have the private channel, which is going into accredited investors. So I think what you typically hear from the asset manager is that the underwriting is the same, the sourcing is the same. It's just how they're allocating it to those different funds. So I don't think there's anything really different going on from an underwriting standpoint in those different portfolios. It's just you're just accessing different channels and more sources of funding.
Okay, so you would dispute that if they cater to more retail clients, they also have to be more aggressive in their underwriting standards.
I wouldn't comment on a rumor. I would say what we hear from management teams is, sure, you have a more competitive environment. You may have, and there's certainly been softening of, underwriting standards, maybe from softening up covenants and stuff like that. But I think the genesis of your question is that they're doing it to certain portfolios and not others. And there, I would say, in general, doesn't mean it doesn't happen. And I don't have a specific example for you that they may have slight differences within those different vehicles, but I think overall they tend to allocate things pretty across the board. But I don't have anything, based on your original question.
Sure. If we stress test a perpetual BDC model, let's say a BDC is getting hit with redemption pressure. What would happen with the structure and the underlying loans? Can they liquidate their debt quickly?
Sure. I think I mentioned earlier, one, perpetual BDCs are typically capped at, gated at 5%.
Yeah.
And it's really up to the manager if they want to expand that. And we've seen that in a couple recent instances. I also mentioned earlier that perpetual BDCs will typically hold a fair amount of BSL loans, which are more liquid. They tend to run relatively low leverage, so if they want to borrow off their line and lever a little bit, they can do that. So the question, what I don't think has happened so far is they're forced to sell illiquid loans and push numbers down all over the place. So I think they're well measured in their thoughts about liquidity. And understanding that they are going to have they know the redemption requests are coming, right? So I don't think it's like a big surprise to them, and I think it's actually a great test for the sector that you had a BDC that said, okay, we'll give you 17%. Boom, it hurts. It's not great. It's not great for for optics, but they can do that easily. And unfortunately, TCPC paid the price with it. So they've had other things going on too, but paid the price with its credit rating. But it's not going to blow it up, right?
Yeah, I think what you're just mentioning is also true for every asset manager, right? If you expect that there are redemptions coming, you also tend to shape your portfolio in a different way than if you would not expect redemptions, right? And I think it's a similar thing here, right?
And like any financial, stop producing loans, you can generate a lot of cash.
Yeah,
it's not good for growth, but you can generate a lot of cash if you stop originations.
Yeah, I think one key point also is that even at the height of COVID, also loans came due, right? So also they got cash into the door during a lot of market stress, so which definitely helped them. If you're looking at historical precedents, I think there was one BDC who failed in the past, Allied Capital. What happened there exactly?
Allied was back in post-financial crisis, had similar things that we talked about earlier about rising non-accruals and PIK. That was quite a while ago, but I believe they also they had some short selling going on against them, some bad reports, and I believe there was some allegations of fraud there and investigated for that, and they wound up getting bought by a larger manager.
Given that there's so much talk about BDCs at the moment, they are still very minuscule in the financials index. I think they just account for 1.7%
of the financials
of the financials index.
Pretty, not of the overall corporate index. Right? Mm-hmm.
So is that really meaningful for systemic relevance, or is it more or less a rounding error?
Yeah, they don't have the interconnectivity that the big banks did. back in the financial crisis. Doesn't mean it can't scare the corporate bond market a little bit, but I don't see it the same way at all. No. And particularly the loans are much, much smaller. You're not levered quite as much as banks were. We don't have sieves and all the different, there was leverage on leverage on leverage. Doesn't mean there's not leverage there. It doesn't mean there wouldn't be some pain, but I don't think a BDC failing would do anything for the financial system. It might hurt some investors. It's not going to take the banking system. Just reason why all these types of assets were sort of forced off balance sheets, banks' balance sheets, right?
And I think that's the key theme, right? Similar as you mentioned, commercial real estate in the US, that was also basically a non-event in retrospect for the banking system, and therefore also did not endanger financial stability in the US or globally.
You need a lot to go wrong, right? So honestly, like I said, the amount of asset coverage that they have, even before you can really try and blow up a BDC, like it might not be pretty for the equity, it might not be pretty for the bonds, but to really blow one up is pretty tough. And you do, in many cases, have deep-pocketed sponsors behind them who are probably not going to let that happen anyway. But to interconnectivity, I don't see it to the extent I saw. I'm not saying there's no interconnectivity, but not to the extent that I saw. Like, what's going to happen as asset values fall? Like, maybe having, but you need kind of all the assets to really take a dive. Collateral requirements are going to go up on wholesale lines, are going to get pulled. They're going to have to stop their originations would probably slow tremendously. In which case, on the stuff that is still paying, where they're going to build a lot of cash, right? So, you really need an extraneous event. I mean, most of these guys lived through 2020. You give me a bigger stress, right? Right. So, I mean, I use that as an example as well.
John, this was super helpful. Thanks for walking us through BDCs. What's the best place for listeners to find you and learn more about your work at Seaport?
Yeah, I would say go to your Seaport sales contact and or look me up, and happy to get you in touch with our research. But yeah, please reach out to your salesperson, and I'm on Bloomberg, of course. We're happy to chat.
John, thanks for coming on the show, and thanks to everybody watching and listening. If you enjoyed this episode, please follow or subscribe wherever you get your podcasts, and see you next time.